Hi guys, today we are talking about the international trade and the gap captive flow. So before I beginning, I will introduce the balance of a trade or trade balance. Balance of trade. Balance of trade is the gap between the nation's export and import. Just the gap. Okay, that is the definition. Let me give you an example. In some high-income economies, such as the United States, goods comprise less than half of the country's total production, while service comprise more than half. So that is a typical one. And then let me introduce the several concepts. The first one is a Mercatus trade balance. This is the balance of a trade looking only at goods. We don't need to consider about others, goods only. Okay. The second one is the current account balance. Different from the first one, the current account balance is a broad measure of the balance of the trade that includes the trade in goods and service, as well as the international flows of income and foreign aid. Let me write down that for you. As well as the Okay, let's keep going. Third one is unilateral transfer. This one means the payments that government, private charities, or individual make in which they send money abroad without receiving any direct good or service. We can understand that it's a kind of the payment that without any good and services. Government, private charities, or some individual, they send money abroad without receiving. Okay, that is the three definition. And then the trade balance in historical and international context. Let me to show you in a graph. So how to stand that concept in a graphically? If we use the y-axis to represent the billions of dollars, and the x-axis represent the year, we can say that it's like in this way. If the lines are above the $0, for example, the United States, if they above the $0, the United States was running a positive trade balance and the current account balance. So, respectively, if the line is below the $0, the United States is running a trade deficit, and the deficit in it is the current account balance. Okay. Then let our talking about a measure of the economy's globalization. The export of a good and a service as a percentage of GDP. The dollar value of export divided by the dollar value of the country's GDP. So that is the So this tells us how to calculate this value. We just use the dollar value of export divided by GDP. Okay, that's it. And then let me introduce about the trade balances and the flows of a financial capital. The financial capital is the international flows of money that facilitate trade and investment. The key word is international. Flows of money. The connection between the trade balance and international flows of the financial capital is so close that economists sometimes describe the balance of a trade as the balance of the payment. So if you see the balance of trade, you can also say that is the balance of the payment as well. Because they're so close. Each category of current account balance involves the corresponding flow of the payment between the given country and the rest of the world economics. Let me to show you by the graph. If we use this one represent the home country, okay? And this one is the rest of the world. Okay, the first line we will write as the export. From the home country to the rest of the world, to another country. And also, we can understand that in the repayment of investment from abroad. Then let's go back to the rest of the world. So that the second line is show the money that home country the second line show the economy the money that home country receives for those export. After we investment money to the other country, we also receive the investment income. From the rest of the world toward the home country. We can also understand that the investment from abroad. Third line is the import from the other country to our home country. And then we can understand that repayment of a foreign investment. No, we don't have enough space. Okay, the last step is investment income paid from the home country to the rest of the world. We can also understand the foreign investment. After we receive the money from other country and make up the profit, we can also invest those money to another country. Let the money to experience the kind of the cycle. Okay. So the balance of a trade as the balance of the payment. A current account deficit means that the country is a net borrow from abroad. Let me write down that for you guys. Deficit means it's the net borrow. Conversely, a positive current account balance means the country is a net lender to the rest of the world. Inflow and outflow of a foreign capital doesn't necessarily refer to a debt that governments owe to other governments. This investment international flows of a financial capital refers to all of the ways in which private investors in one country may invest in another country, such as the buying the real estate, or buying companies, and then like some financial investment like stocks and bonds. Then let us continue. The national saving and the investment identity. So how to calculate that? That is mean the total of a private saving and the public saving, or the government budget surplus. So how to calculate? I will use the several characteristics to show that for you guys. So first let me to introduce some single characters. Let's use S to represent the saving by individual or firms. And then we use the M minus X to represent the import minus the export. Do you guys know what that means? Okay, that is means the trade deficit. And then I. We use the I to represent the private investor. Investment. And the G represent the government spending. The T is the taxes collected. Okay. So first of all, let us to have a assuming that the supply of the financial capital is equal to the demand for financial capital. So the S minus the trade deficit, which is the M minus X, should be equal to the investment plus the government spending minus the taxes, right? If the G greater than the T, which means the government spending more than taxes collected, so the government would be a demander of a financial capital. Conversely, if the taxes collected is more than the government spending, then the government would contribute as a supplier of the financial capital. Then let's introduce the domestic saving and the investment determine the trade balance. The connection of a domestic saving and the investment to the trade balance explained why economy view the balance of a trade as the fundamental microeconomics phenomenon. In the case of a trade deficit, the national saving and the investment identity can be written as the M minus X. We mentioned that before. Is the M minus X is equal to the domestic investment minus the private domestic seeking and then minus the government saving. We can use the T minus G represent the government saving, which is the taxes minus the government spending, right? Investment, that is the I minus the private saving, which is S, and then minus the government saving, T minus S. So the only way that domestic investment can exceed the domestic saving is if capital is flowing to a country from abroad. Then, in the case of the trade surplus, the national saving and the investment identity can be rewritten as the instead of the trade deficit, we use the trade surplus. Different from the trade deficit, the trade surplus is the X minus M. X is we mentioned here is the export. Export and minus the import is the trade surplus. Is equal to the private saving plus the public saving or government saving. I think if we still use the G minus T to represent the government saving and then minus the investment, domestic investment. So that is the equation for the trade surplus. Domestic saving is higher than domestic investment. The extra financial capital will be invested abroad. The national saving and the investment identity also provide a framework for thinking about what will cause the trade deficit to rise or fall. Let us say based on the trade deficit equation, I will rewrite this equation over here made it more clearly for you guys to see. Equal to the M minus the trade deficit. If the I go up in more investment, but the private saving is no change, the public domestic saving, which is T minus G, is no change, so that the deficit, which is the M minus X, will be raised, right? And if the investment is no change, the private domestic saving is up, which means minus the more private saving, the public domestic saving is no change. Then the trade deficit will be full. If the investment is no change, the private domestic saving is no change, the public domestic saving is down. What will be happened? The trade deficit will be raised. Okay. That is how you guys can use this equation to predict to predict the trade deficit by the investment and the private and the public saving. For the short-term movement in the business cycle and the trade balance, in the short run, whether an economy is in a recession or on the upswing can affect the trade imbalance. A recession trade to make a trade deficit smaller or trade surplus larger. That is during the economy recession, our trade deficit is normally become smaller, and the surplus respectively will be larger. Well, during a period of strong economic growth, our trade deficit will increase and the surplus will decrease. Will become smaller. We can say that. For countries, there are no economic merit in a policy of abstaining from participation in financial capital market. It can make economic sense for a national economy to borrow from abroad as long as it wisely invests the money in ways that will tend to raise the national economic growth over time, such as if we borrow the money from other country, how to use the money is a key one. If we use the money wisely and appropriately, our economy will be greater than before. The example is the United States in the and the South Korea. In 1970s. Let me just show that it is the great way to use respectively. If we didn't use that wisely, a borrower nation can find itself in trouble if it does not invest in the incoming funds from abroad in a way that leads to increased productivity. So that will make our economy in the wrong way, such as the Mexico and Brazil and some African nations in the 1970s and the 1980s. That is just an example. So a country's level of trade tells us how much of it is production it export. We should separate the term than the balance of the trade, and we need to measure it as a percent of export out of the GDP. There are three factors strongly influence the nation's level of the trades, such as the size and the location, geographical location, and also the history. So these three factors will influence this country's level of the trade. Trade deficit can be good or bad sign for an economy, and the trade surpluses can be also a good or bad sign for the economy. So we cannot use the deficit or surplus to to predict how this economy grows in this country. Even the trade balance is of the zero, which is just mean that the nation is either a net borrower or lender in the international economy, so that it can be either a good or bad sign. The fundamental economic question is not whether a nation's economy is borrowing or lending at all, but whether the particular borrowing or lending in particular economic condition of that country makes sense. So we cannot use the trade deficit or surplus cannot directly predict economy level. How to use the money is the key point.